Cyclical and non-cyclical stocks. These terms, cyclical and non-cyclical, refer to how highly correlated a company's share price is to economic fluctuations. Non-cyclical stocks generally outperform the market when economic growth slows, while cyclical stocks are highly correlated to the economy. The non-cyclical stocks are also called defensive stocks. They profit regardless of economic gyrations because they produce or distribute goods and services we always need: food, power, water and gas. The sales of companies with cyclical stocks, on the other hand, depend on whether or not the economy is strong. Sales will thrive when people have extra income to spend on luxuries, and they'll decline when the economy slumps. The difference between cyclical and non-cyclical industries is simply the difference between necessities and luxuries. There are certain items we can't live without and won't likely cut back on even when times are tough. The stocks of companies producing these products are called non-cyclical and provide great places to invest when the economic outlook is poor. For example, household non-durable goods such as toothpaste, soap and shampoo may not seem like essentials, but our spending habits on these items are likely to remain unchanged regardless on the economy. On the other hand, a car purchase in the automobile sector, for example, would be cyclical, as you are more likely to postpone this purchase for a year or two if your finances feel the effects of an economic slump. Other examples of cyclical industries are manufacturing, the steel industry, travel and construction, the sectors that produce things we can live without when money is tight. These are exactly the types of industries you want to avoid when the economy turns sour.